The story is this, and this is also Benjamin Graham. Benjamin Graham has been misquoted, very much misquoted. They say that Benjamin Graham says that on the short term, the stock market is a voting machine, yep. But in the long term, the stock market is a weighing machine. Benjamin Graham never said that, and it's very illogical to say that. Let me give you an example. At the 2000 top, there are many, many long-term companies not involved in the internet that were very, very undervalued. Right. Now, if stocks are fairly valued over the long term because the market's a weighing machine, why would a stock ever be undervalued if a stock has a 30-year history of earnings? It's long term. If in the long term, yep. Markets are a weighing machine, let General Motors always be weighed, let General Electric always be weighed, it doesn't work that way. Benjamin actually said that the market is not a weighing machine. It is strictly a voting machine. Because he says, it's in the book, Graham and Dodd Analysis, he says because although possibly fundamental factors affect stock prices, and possibly monetary factors affect stock prices, and probably psychological factors affect stock prices, the reality was in order for the stock price to change, you need a buyer and a seller. Yeah. So no matter what you're going to say about fundamental analysis, the actuality is that the given change of a price of a stock is based on voting, based on a buyer willing to buy at a certain price and a seller willing to sell at a certain price. So this is very important. Once you realize that the stock market is a voting machine rather than a selling machine, you also realize that most turns in the market, or nearly I'd say all turns in the market, are sentiment-based and yes. Psychologically based rather than fundamentally based.